Hello and welcome to the 12th of our ACCA P7 Advanced Audit and Assurance lecture recaps. This was the first of our lectures on completion, but first of all we want to look at initial engagement under ISA 510. So the requirements under ISA 510 are to ensure that the opening balances don't contain material misstatements. You also have to check last year's figures and make sure that they're brought forward correctly. If there have been any restatements, you have to make sure that the figures reflect those restatements. You also have to check that consistent policies have been applied to both sets of accounts. Have any changes in accounting policies been disclosed? To do this, you'll consider whether the accounts were audited last year. Was there a qualified audit report? Was it resolved? Have there been any adjustments? If there have the ledgers been adjusted to reflect those adjustments? If there was no audit last year, or they were audited by another auditor, what should we do then? Well, the first thing we've got to do is we'll consult management. We'll also review the records and controls that were in existence in that prior year period to make sure that we're happy with them. If there was a previous auditor, consult with them. And if we're not happy, we need to test the opening position to get comfort over that position, that we're happy that it doesn't contain any material misstatements. Comparative information then. The key thing on this is that comparative information is required to comply with the framework and to be free from misstatement. Corresponding figures are comparative information. They must be these things. You have to ensure that they have accounting policies that have been consistently applied and that the figures agree to the prior year. So those are the key things, that the accounting policies have been consistently applied and that the figures agree to the prior year. Reporting, well, if there was a prior period misstatement, you need to check if it was resolved and if the accounts were restated. If they were, well, then you'll include an emphasis of matter paragraph to draw the attention of the user to that. If it wasn't resolved, you'll have to carry that qualification through to your audit report this year. If you include information for comparison, i.e. comparative information in the accounts, again, you have to evaluate whether the accounting policies were consistently applied and whether the figures agree to the prior year. On then to other information under ISA 720. By other information, we're talking about things like the chairman's report, other reports, and 5-year summary. So other information that's included in the accounting or the accounts document, but that doesn't form part of the actual financial statements. The two things we're looking to identify here are material inconsistencies in those reports, or misstatements of fact. So if we find these, how do we report them? Well, first of all, material inconsistencies. If we find a material inconsistency, there are two possibilities. The first is that the report is wrong, in which case we have to ask the directors to change it, and if they don't, include an emphasis of matter paragraph in our report. Secondly, the accounts could be wrong. If so, we need to amend the accounts, and if the accounts aren't amended, we'll put an except for paragraph into our audit report. The second thing, a misstatement of fact. Well, if we see a misstatement of fact, we have to speak to management. We'll have to include an emphasis of matter paragraph if they refuse to change that fact. If you're still not satisfied, you can refuse to report or resign, but seek legal advice to make sure that you're within your rights to do these things. On then to post-balance sheet events, and this is under IAS 10. So ISA 560 says that we should be looking for adjusting and non-adjusting events. An adjusting event, first of all. Examples of an adjusting event will be damage to inventory, doubtful debts after the year end, the price of a non-current asset that's determined after the year end, an agreement of a tax liability after the year end, or a discovery of fraud and error, all of these things will be adjusting events. Remember that they have to be material. Why is it adjusting? Because it's evidence of conditions that existed at the balance sheet date. Okay, so therefore you should adjust the accounts to reflect that condition. So it's a correction that's required. So it has to be material, and it has to be evidence of conditions that exist at the balance sheet date, and therefore you need to correct the financial statements. That's as opposed to a non-adjusting event. A non-adjusting event is an event that arose after the balance sheet date. It's still material, but it arose after the balance sheet date, and in that case we need to disclose that event. Such things as a share issue, fire in a warehouse which damages stock, purchase or the sale of significant assets. And the auditor will have various responsibilities for this. It's split into 3 different sections. The first of these is an active responsibility. The active responsibility of the auditor is up until the date of the report. At that time you have to identify events, consider the impact of those events, and consider qualifying your report. A passive responsibility then exists from the date of report up until the financial statements are actually issued. During that period, if information arises, you have to ask them to amend the accounts. You may need to reissue the report, and if the directors refuse, you may consider resigning, or you may consider calling an extraordinary general meeting to inform the shareholders. Your responsibility then continues after the issue of the report. If events come to your knowledge after the report, you may want to issue a new report that will include an emphasis of matter paragraph. If the directors refuse, you may seek legal advice on it. So, what procedures should we use to try and identify these post-balance sheet events? Well, first of all, you're going to look at management procedures for identifying post-balance sheet events. Are they suitable procedures? Are they likely to work? You need to have a look at those procedures and see if they are correct. You'll review the minutes of the board meetings, etc., to make sure that no events are outlined there that you should be aware of. You'll review management accounts, cash flow forecasts, all of these sorts of things to see if there are any events that are contained in those. You'll ask the directors, are they aware of any events? And you'll seek a management representation letter stating that they're not aware of any post-balance sheet events. Lastly, remember that we are considering amending the accounts, issuing a new report, and that we need to inform the shareholders if we find significant matters. And that was our lecture on completion.